Morning, y'all. Y'all already know it's your boy, Jamal, Love It Up Credit Services. Um, Today I wanted to talk about home buying. Over the weekend, I asked question, why do you want to improve your credit? And a lot of people mentioned they want to buy their first home or just buy a home. It may not be their first. So I figured it'd be good to just talk about generally, okay, generally national average, okay, because home buying, there are a lot of variables, and I'm only going to be speaking on it from the retail standpoint, as opposed to if you're trying to be an investor or even wholesaling, because they have totally different rules. You know, if you're wholesaling, they'll tell you that you don't even need cash or credit, et cetera, et cetera. But most people who responded, they're not in the wholesale, they're not in the commercial real estate development side. Disclaimer, I am not a realtor. I'm not a loan officer. I'm not a mortgage broker. I'm not in the real estate industry, but of course, being a credit counselor, helping folks qualify for mortgages and home loans is, a daily thing. So I figured I'll just get on here, share a couple of things about like your credit score and preparing for the process prior to even getting pre-approved. Okay. So another disclaimer is that it will vary by state. It will vary by what bank you go to. So a lot of people are going to hop on here and they're going to tell me that I'm wrong. That's not how it works. You're going to have to shop around, right? So, your credit score. Now with the FHA loans, okay? FHA, your credit score as of today can go all the way down to a 500. Yeah, you can buy a house with a credit score of 500. However, you'll need to be able to put down 10%. Okay. Now, if you have, if you only want to do the 3.5%, which a lot of people talk about because it's a great way to purchase your home for less money out of pocket, your score would need to be at least a 580. Now, I'm in Maryland. That's also very important to know. I'm in Maryland. Again, it's going to change by state. Hey, see, what's up? And in Maryland, lenders really want you to have at least a 620, okay, even with an FHA loan. But nationally, on record, on paper, to get the 3.5% down payment, you'll need at least a 580. Now, as far as, let's say you have time to build your credit score, for me, I'm always about, because y'all may not know this, but I'm cheap, right? I don't pay full price for any goddamn thing. Nothing. And if I do have to pay full price, I'm swiping it on a credit card so I can get anywhere from 1 to 5% back of whatever I spend, right? So for me, if I already know I have time to improve my credit, why do a 580? Why do a 620? You're going to get the best financing options, right? You're going to get the best financing options at a 720 and above. Okay. You're going to get the best, absolute best terms, interest rates, because interest rates are already crazy. So, now if you're in a situation for whatever reason your credit is low and you have to move, or you just feel like you have to buy something, again, 580, 620. The cool thing about that is, even though you get into your house, into that mortgage with a lower credit score, as your credit improves, let's say it improves to 720, 750, you can always refinance the house potentially into a lower interest rate. Okay. That is after you're in the house, if you just need to, for whatever reason, get into the house. Another thing is, along with your credit, you're going to need money. Okay. You're going to need cash to put down your down payments. And you're going to want to make sure that you calculate exactly how much you're going to need. This includes closing costs, because it's not just about the down payment itself. You will have to pay, like, mortgage origination fees, the fees for the title company, and they do the what's that thing when they outline your perimeter, all that type of stuff, right? You're going to need that, and that dollar amount is going to change. Unfortunately, lenders will tell you something in the beginning, then when you get the closing table, they're going to tell you some other outrageous ass number. Now at that point, you can still negotiate or just say, nah, I'm not going to give you that, what have you. And whatever they say and how that goes is how that goes. But don't, at the same time, you want to keep yourself protected. The earnest money deposit, that's also part of it. Earnest money is about 1% of the purchase price of the house that you're looking at. And so there are some things too with earnest money that's kind of like a down payment. And never mind, I'm not even going to get into I'm not even going to get into that. That's a whole nother can of worms. But the companies, they'll tell you one price for closing costs, and then as you get closer to closing, they'll tell you another price, because like, the percentage, like your interest rate, can also change before closing, because they check that. Well, you probably already know the Fed and the interest rate for the country determined by the Fed changes like damn near daily, right? So it's quite possible that the terms of your loan can change just before closing. Your interest rate can go up. It very rarely goes down. So that's also something to just keep in mind, right? And there are a lot of programs out here that help you with down payment assistance. Going back to your credit score now, with companies like Bank of America, which a lot of people are so upset about, and NACA, right? Because Bank of America backs NACA. You may not even need a credit score. Now you don't even need a down payment, right? Because they offer you a $10,000 to $15,000 grant. Now, Bank of America isn't the only company that offers grants for down payments. A lot of companies offer it. Here in Maryland, we actually have something that's super dope, called Smart Buy. In the Smart Buy 2.0 program, they give you a $5,000 forgivable loan towards your down payment. They also do something amazing where they will, for those who tying in this into student loans, they'll actually give you up to $40,000 that go towards your student loans, okay, when you close on your house. So if you tie this in, because it's another thing I do, credit strategy as well. So it's all about stacking benefits. So we're already getting 10 to 20,000 from Biden, right? If you're in Maryland and you qualify for the Smart Buy program, tack on another 40,000. So now you're going to buy a house, and you're going to be reducing your student loans potentially by 50 to 60,000. And with the Smart Buy program, it's super dope because it is a 5-year forgivable loan. So that does mean you'll have to be in the house for at least 5 years. And in year 6, they forgive that portion of the loan. So you're stepping into a new house with less student loan debt. Again, Maryland only. With Smart Buy, you typically are going to need a 680 to qualify for the Smart Buy program. Okay. Now, with these other things, you have other kinds of loans to qualify for. Like, of course, the two of the best is the agricultural loan, or the USDA loan, and the VA loan. So if you're a military veteran, VA loans are amazing. It's some of the best you can get. And with USDA loans, they are specifically for folks who want to move into like a more rural area, or if they plan on, breaking ground in a rural area. So like In Maryland, we have areas in like Brandywine that may qualify for a USDA loan where you have to put down less money. And with the housing market right now, interest rates are going up, prices are coming down. So it's one of them things. A lot of people say that the Bank of America loan is bad. Is one of them things where it's just another tool, right? Because either way, when you're stepping into a mortgage over the 30 years, you're going to end up paying two to three times the cost of the actual home, right? Because we're talking about a 30-year loan at freaking 5-6%. So either way, you're going to be stepping into a house and you're going to be paying at least double what the initial cost was. Okay, so keep that in mind when you're looking at these homes, right? You don't have to rush the process. They're going to tell you that inventory is low, but you see these homes, they out here. You see these loans, you see the homes, they out here. There's plenty of places to live, for real. But again, from this credit standpoint, right? You can, depending on where you live, with programs you start with, you can go buy a house now with 0 credit score, right? But what Bank of America and these other no down payment, no credit score companies are going to be looking at, they're going to be looking at your payment activity and your payment behaviors. So this is called alternative data in the world of credit scoring, credit modeling. Alternative data is all the information that usually does not appear on your credit report. So one company that's made it really popular is Experian. They have the Experian Boost, where it connects to your bank account and then extracts all of those like utility payments that usually don't appear on your credit report. Things like your rent, your electric bill, your water bill, your cell phone bill, your cable bill, right? Now, personally, again, at flip side, as a consumer counselor, I do not advise anyone getting Experian Boost. Even when you're going to closing and you're going through the home buying process, they are going to tell you to remove Experian Boost because it's going to mess up your DTI. Transition. What is DTI? DTI is your debt to income ratio. It's a percentage that represents how much of your income you're spending on debt. Now, in the past, the limit was 40%, but I've recently been told and educated that some programs allow you to go up to 55% DTI. Now, what that means is that you're spending 55% of your income every single month. So, can you be deep in debt with terrible credit and buy a house? Absolutely. Between Bank of America and programs that allow you to have 55%, you can absolutely step into a brand new house all fucked up, house poor like a motherfucker. You can absolutely do that. I don't advise it, right? I don't. It's not where you want to be, right? So, but if you just want to have a house for the sake of wanting it, and you have a plan at least to improve your situation after your home, after closing, etc., then, knock yourself out. But just generally speaking, I would not advise anyone to attempt to purchase a house with 55% DTI. That is more than half of your income is going towards debt. And so how do you find your debt to income ratio? You are going to take your monthly income, all of your monthly income. So if you have multiple jobs, side hustles, other income streams, you're going to add all that up and you're going to divide it by your monthly expenses. Okay. So, when your loan officer is looking at it, or the lender's looking at it, they're going to be looking at the expenses that they see on your consumer report, right? So that's typically, your loans on your consumer report, personal loans, personal credit cards, other personal mortgages, other personal debts. And I specify personal because none of your business debt appears on your personal credit report. So when you're qualifying for a house, none of your business debt is taken into consideration because it's not on your consumer report. Okay. And so you'll take your total income, you'll divide that by your total personal consumer expenses for the month. You'll divide that percentage will give you your DTI. Okay. I think healthy, you want to be under 40%. Okay. Yeah, just stay under 40%, right? You don't want to be above 40% because that's crazy. 40% is a lot. Like 40 cents of every dollar you earn is going to an expense. That is huge. That is massive. That's a lot of damn debt. You don't want that. Okay, so that's what the DTI is, and you can shop around to different lenders. A lot of people will say, well, how do you find a good program, this and that? Google, y'all. You don't have Google. It's that easy. Is that literally everything I'm saying right now? I can Google it. I Google and I just ask people that are in the industry, right? Or I'll post something and then someone who is who's in the mortgage field or something, they'll hit me up, let me know, and share information. But you can literally Google. If there's a bank that you think you want a loan from, go onto the bank's website. They have their interest rates. They have their terms. They have the different type of loans that they offer listed right there on the website. You don't have to guess. You don't have to be blindsided, okay? Buying a house is the largest purchase the average person is going to make in their life. So why guess? Why guess? Why walk into the situation surprised, not knowing how much of a down payment you need, not knowing how to qualify for a certain type of loan? You don't need to guess. You can walk into the bank and ask them because they definitely want to put you into a $250,000 mortgage for 30 years at 5%. They absolutely want that to happen. So yeah, they're going to give you all the information that you need about their mortgage programs because a $250,000 mortgage is going to blossom into like damn near $550,000 over the course of 30 years. Absolutely, they want that bread. I want that bread. Let me lock you in to a 30-year anything at 5% interest. Yeah, what you need to know about it. I'm going to tell you everything. Everything that's going to benefit me. That part. So, please just do your research. Go to any credit union. Credit unions are also great because they typically have nicer, more consumer-friendly terms than the big banks. So like lower interest rates, maybe more down payment assistance, etc. Okay, and Google smaller banks that are local to your area. They typically have better rates, better terms. Terms is just like the length of the payments available. Okay. And a lot of times with homes, you have like a 30-year mortgage and a 15-year mortgage. Now, from the budgeting standpoint, a lot of financial planners and accountants will even say get you a 15-year mortgage. That way you save on interest. Now, the flip side of that is if you're taking a 30-year mortgage and condensing it into a 15-year mortgage, from the standpoint of income, you are now doubling your monthly payment. So if your house was going to be $1,500, you're like, nah, I want to save on interest. I'm going to do a 15-year mortgage. That $1,500 payment is now going to be $3,000. Can you stomach $3,000 every month, right? The flip side, we're getting a 30-year. Yes, potentially you'll pay a lot more money over the course of the 30-year, but now you have flexibility because let's say you get a 30-year mortgage and just treat it like a 15-year mortgage. That gives you that flexibility in case life happens, right? We're in the middle of a recession. We are in the middle of a recession, right? The moratorium on evictions and foreclosures has been lifted. So all of those pandemic protections that people had aren't there anymore. So yeah, them foreclosures and evictions is coming at a rapid pace. Okay? Rapid pace. So if you're in position to buy something, this is going to be a great opportunity because we're going to have a flood of new inventory coming in, right? From the various evictions and whatnot. Plus the cost of the homes are going to be dropping because you got to remember, these homes were selling at all-time highs, like inflated prices during the pandemic. So it would make sense that their prices are going to come down because they were overinflated to begin with. So yeah, prices are coming down, but homes were selling for 30, 40, 50, $100,000 more than what they should have been. So that's the other way to think about it, right? Because, you know, the media is going to tell you these different things and make you panic. But it's like, yeah, of course the prices are going to come down. They were too high to begin with, so they need to come down. And that's better for me. Is you're going to buy the shit on sale, right? If you're able to buy a Louis Vuitton bag that was $20,000 for $5,000, you're going to want to get it at $5,000. So these are just some couple of things for y'all to think about. And I hope it was helpful. So yeah, definitely do your own research, look banks up, look up credit unions, look up state-run programs. Like I said, I mentioned Smart Buy, because that is in Maryland. I don't know if it's national, but if it is national, or if your state has something similar to that, check it out. Because a lot of us are still dealing with student loans. If I can get $20,000 from Biden and then $40,000 from the state and knock out $60,000 of my student loan and buy a house, that's a win. So hopefully this helps y'all. Hopefully this was some insightful information. Let me know. Hit me up if I missed something. Let me know. All right. I'll talk to y'all. Have a great Monday. Peace.